thank you, Amy, and thank you, everybody. Good day, and welcome back to Hyde Bailey's webinars on GAAP for state and local governments, as well as compliance. And today, I hope this is the last word on GASB 87 for leases. We know you're focused on GASB 87, but we've been doing this so long, we're doing this in our sleep, and we're really close to the finish line here on GASB 87. We're indeed at showtime for implementation. By my calendar, it says it's June 22nd, which means that for you June 30s out there, we only got about another 8 days. And as Elvis sang, it's indeed now or definitely never. So with that, I did this one too many things. My name is Eric Berman. As you know, I'm a partner with Hyde Bailey out of our Boise office, and joining me today are again two other partners who also worked with me the last month during our lessees last stand presentation. Again, Brian Stavager, he's out of our Fargo office, and Brian's been with Hyde Bailey for over 21 years. And he works with a lot of colleges, universities, utility cooperatives, local government entities. Also joining me is James Ramsey from our Northern California offices. James works with governments throughout California, providing accounting, assurance, advisory services, and he's been on both the client and the assurance side. And because he worked at a small city and performed most of the functions of a finance department while he was there. So okay, now to get things rolling, we're going to give you one last in-depth look for on GASB 87 for lessors. And again, as many of you are June 30 governments, we got 8 days. It's here. And we also have, again, breaking news. We have a brand new standard out there, GASB 99. Actually, we're now up to GASB 101, and we have another exposure draft out that was just approved yesterday or the day before yesterday. But that's beyond the scope of today. So GASB 99, that's going to impact some of the decisions you may have in implementing GASB 87, especially in recognition of a short-term lease. I got to do this. A loophole that is within the short-term provisions is going to be closed by the implementation of GASB 99. Now, before you head to the exits, the provisions we're going to be talking about will be implemented for periods beginning after June 15th, meaning last week. But again, since most of you are June 30th, we're talking 9 days from now. So again, don't worry about it, for this implementation, unless you're going to implement early. Now, the changes may require a beginning balance adjustment, so it's prudent for us to look at them really carefully today. Now, given that it's after June 15th, we also have GASB 94 and 96 to consider. Now, there are no governmental vendor provisions in GAAP for GASB 96. So what we did last month, that's going to work on that end. We're also going to talk again, remind you about some audit issues and implementation strategies, because we kind of sped through that last time, so we might as well repeat it again. Okay, just in case you're new to government or you need a refresher course in GASB 87, gosh, this has been, a long, strange trip since November 2019. But we really began when the standard was being deliberated and researched by the GASB. And I remember doing this stuff live back in April 2013, talking about this upcoming lease project. And so I've been talking about leases for over 9 years. And you can tell, yeah, I'm at my last stand on this one. And, each contract is different. And as much as I talked about it, I still see stuff every single day that makes me think, I got to really think about this one and do a bunch of research. And there is not a day that I don't, that I don't say, gee, there's something. So again, You can see all these on YouTube. They are there for free, but you don't get CPE. They're up, but they're all there. You know, you really don't have that much to do. I mean, after all, you know, the US Open was last weekend just down the street from where I'm speaking in Brookline, Massachusetts. That was awesome. You know, the NBA is all done. Unfortunately, my Celtics didn't make it. Stanley Cups are in the Stanley Cup is in the finals, and we're not July 4th yet, but the, you know, evil empire of the New York Yankees, they've already got 50 wins, but there's always hope for my Red Sox. All right, so let's just start off with an overview of GASB 87. But again, we're just taking a look at the lessor side. Now, as a reminder, if you've been under a rock, you know, for a long time, and you're looking for that get out of jail free card because, hey, you know, everything's taking a lot longer these days than it used to, you know, and you're looking for that again, get out of jail free card. No, we are at the end. We are here. You got to implement. No bones about it. You just got to get real, get your hands dirty, and it's go time, everybody. So no more extensions. Once again, GASB 87 is part of a global change in the lease accounting and reporting framework. Both sides of the table are changing, where your government is a lessee, which will be most common, but also where your government may be a lessor. And we're finding a lot of lessor governments are climbing out of the woodwork here. And we signed up a few last week as clients that they have predominantly lessor contracts. So you may indeed be one of those folks. Now, by the way, the lessors you deal with, they're also changing because this is a global change in accounting for leases, international, for-profit, not-for-profit, the federal government. All entities have very similar models in leasing. Travel nations, airports, ports, utilities, casinos, entertainment venues, they are all implementing at the very same time you're doing your implementation. So don't feel like you're being singled out as a government. Now, the reason why these are changing, these standards have been in place since the 1970s and in some aspects since the 1940s, and they just needed to be updated for current practice. They didn't fit the current reporting model that we have. And due to this lack of evolution, a lot of your contracts that we're looking at have been engineered to fit into the various exceptions to make them operating leases. And there are operating leases that are out there that really are non-cancelable, and yet, you know, they're listed in your annual financial report and your note disclosure for going out for decades. Just look at what you have. And in most cases we've seen so far, all of those ones that are going out for decades are being converted into leases that are not short-term. And again, this financial engineering was put into place for a number of good reasons. In many cases, governments are limited from issuing any form of debt. And when we implement GASB 87, for lessees, a lease is a debt. After all, as a lessor, you sign a contract and the lease has to fulfill the terms and conditions of the contract, and you got to live under the constraints. And one of those terms is that the debt needs to be paid somehow, some way. And after all, you know, if you don't pay the debt, you're evicted. Now, over the last 2+ years of working with our clients to implement, I thought I'd seen it all. And again, every day there's something new that amazes me. And some of that has to do with the engineering that has been done. We really need to move forward, as there are other standards that we're going to be dealing with over the next couple of months together. And so let's just focus on GASB 87 for lessor. So again, if you haven't started as of yet, now is the time. So under GASB 87, what's a lease? A lease is a contract that conveys control of the right to use a non-financial asset, also known as the underlying asset, for a period of time as specified in the contract, in an exchange or an exchange-like transaction. I should be able to do that with my eyes closed by now. Each of those phrases is precious, especially these words exchange and exchange-like, in similar agreements in your government that may not be in scope under GASB 87. Now, notice we're using the word contract, and that is vital. Many leases do not have the word lease in them. They don't have the word rent in them. But there's a paragraph in GASB 87 that says basically just that leases include contracts that are not identified as leases explicitly, but they meet the definition of a lease. So we're really looking at all your contracts. Now, what's a non-financial asset? It's almost as if you would know it when you see it. But guess what, folks? Non-financial assets are not currently defined in GAAP. And again, we're probably going to see an exposure draft on that one during the middle of 2023, but let's hold off on discussing it. Whatever the proposed language from the GASB, if it sails through, we may see a new standard on that on March of 2024, but you kind of know what it is. If it's not cash and investments, then it's got to be a non-financial asset. And yeah, we have a gray area in terms of receivables and prepaid assets. And prepaid assets are kind of the mongrel dog of the asset side of the statement in that position. Are they financial or non-financial? Who knows? But we may presume that capital assets are non-financial, but what about all these right-to-use assets? So it's just not as easy as it sounds. So an exchange and exchange-like transactions, let's say your government's a lessor and lease land to an unrelated party for $1 a year when the value of the land is $100,000 per year. Well, guess what, folks? That's not an exchange or an exchange-like transaction if the market rent is higher, which means this is not a lease. And I was going through a contract for a client last week, and the lease was for like $400 a year for a huge plot of land. And I said, okay, what's the market value of that land? And they pulled the assessed value and it was far higher. And I said, not an exchange or exchange-like transaction, even if you present valued it over 30 years. And the most common examples of exchange and exchange-like transactions are really, things like that you deal with as a government on a day-to-day basis: licenses, permits, developer charges, some donations as well. Now, remember what assets are. Assets are resources with present service capacity that the government presently controls. That kind of is easy until you get to leases because of some of these aspects. And it's really a game of Jenga. We may see things that we never really thought of before. And look, I see it in the questions we receive every day. What about a multi-year agreement for a right to use a building? Now, the government has exclusive use of the building, but only for 3 days a week. And other parties use the building on the other days. Now, if the government contract stipulates only 3 days a week and the government's fulfilling the contract, then GASB 87 applies, assuming it's an exchange or an exchange-like transaction. And I got that last week from a school district that leased, space to an after-school program. And they said, gee, is that a lease? Well, is it in the contract, for the after-school program? Yeah. And do they only have it for a few hours a day? Yeah. Is it stipulated in the contract? Yeah. It's a lease as long as it's an exchange or exchange-like transactions. Now, solar farms, again, they can be tricky. Now, let's say, your government as a lessor enters into a contract where the business is going to design and build a solar farm based on your specifications. Now, the solar farm is going to be located on your land, but title to the solar equipment is going to be retained by the solar company, who are going to determine the nature and manner of the use of that solar farm. Now, the contract requires the government to purchase all the power generated from the farm and make payments based on the amount of power generated. Now, that's a common contract. And at the end of the day, it requires the business to dismantle the contract and remove the solar farm at the end of the contract. Now, this contract would not meet the definition of a lease And it's because GASB 87 provides two criteria that should be present for a contract to convey control. Now, in the case of the solar farm, the government has the right to obtain power from the solar farm, but it doesn't have the right to, figure out the nature and manner of use. Now, therefore, the component of the contract that provides the government with the right to all the power generated from the farm, that doesn't meet the concept of conveyance or control, and it doesn't meet the definition of a lease. However, the component of the contract that allows the private party to use the property, well, that indeed may be a lease. So you got to think about these and delve into these contracts. You see a lot of those similar types of contracts in cell phone tower leases as well. Okay, now, armed with all of those caveats, how do we get organized and implement GASB 87 on the lessor side? You got to start figuring out what is in scope and not in scope. Governments routinely sign contracts that may or may not align to the definition of the lease. Now, again, you might not see the word rent. You might not see the word lease. And in many ways, these contracts, were designed to, circumvent a lot of laws, regulations, and so on. So you got to gather all these contracts. And again, for some of you, this may be a lot of work because in some cases, they're in various departments and you may be very widely dispersed governments. And once you have the stack of contracts, either in paper or electronic, then you got to make some notes. You got to know which party is your government. Is my government the receiver of the funds, meaning the lessor? You may be both a lessor and a lessee in the case of a sublease or a leaseback situation. So again, all this stuff has to be noted. And then you got to make notes of any special provisions. And the most common may be sale provisions, including the ability to sell the building at the end of the lease for, say, $1, or the ability to sell the land to the lessee for $1 at the end of 40 years. Remember, there may be provisions where your government does not have the control over the property being leased. You got to share it. That's called non-exclusive use, and put that as part of your documentation. There may be minimal payments from the lessee for the first, say, 5 years, say $1 for the first 5 years, and then $10,000 as of the last payment on the building. Now, that may or may not be a lease. There are tons of flavors of special provisions that the lessor may put in, all of which should be documented as part of your due diligence. So, okay, we have a pile of contracts. Maybe we start a spreadsheet. Maybe we do a database of them all. That's a great start. So let's set up a pile of contracts in a conference room somewhere. So there are going to be some that are in scope and some that are out of scope. So we have to be careful. Okay. So our first pile, we're going to set up contracts that are going to be out of scope because there's other gap that's out there. The first pile is going to be service concession arrangements for golf courses, higher education bookstores, cafeterias, dormitories. Hold those aside. Some may be in scope because as of last week, as of June 15th, we were supposed to start implementing GASB 94. But they're not reported until after July 1st when we turn the calendar for you June 30s out there. Now, our next pile, there could be borrowings out there related to conduit debt issuance, and you know who you are if you issue debt or are party to a debt. Those issuers include housing finance agencies, water and sewer infrastructure agencies, and so on. Now, some of these issuances may be conduit debt. Again, let's hold those aside for now as we have GASB 91 also coming up. Started last week, and we're going to implement starting after we turn the calendar to July. Now, notice we didn't say anything on software. As again, there's no gap out there for governments that are purely software vendors. And if you're one of those, we can have a really interesting conversation about it. Now, our next pile is going to be any of these contracts that transfer ownership. And again, they're really financings or borrowings as long as they don't have a termination option. Now, remember in the dark days, uh, back way before COVID, back way before GASB 87, we used to call these sales type leases if they resulted in a gain or a loss, or direct financing leases if they didn't have a gain or a loss. And I signed a lot of these when I was a state controller. Now, there was a third flavor, which were called leverage leases. Those were lease arrangements which were financed through the lessor with help from, say, a bank. And in a leveraged lease, the asset is rented with borrowed funds, especially using conduit debt. In these cases, again, some of these were known as tax-exempt lease purchases or certificates of participation. A leverage lease was commonly used when the government doesn't have funds to buy the asset outright, nor do they necessarily want to keep the asset for a long term. I haven't seen leverage leases since probably before the Great Recession back in 2008. I have a funny feeling those days are gone, but who knows, with inflation, maybe they're coming back. We need to consider those now, but again, those need special work. Now, there's a pile for special provisions for lessor contracts, such as airports, ports, defined benefit plans, or where the underlying asset is an investment. We're going to hold those aside for now. Okay, I got my piles of contracts. So what can I throw back in the dusty file bins? My biological assets, my inventory contracts, my supply contracts, contracts where there's not exclusive use of the underlying asset, those go back into the dusty file pins. So to recap, what are my piles as potentially as a lessor? Service concession arrangements like your municipal golf courses, some convention centers, dormitories, those are and public-private partnerships. Those, are going to be my first pile. Conduit debt arrangements, they're going to be in my second pile. Sales and other transfer arrangements, those are going to be in my third pile. And then everything else that is subject to GASB 87, including regulated leases for airports, ports, and a handful of other entities that truly Scouts honor are regulated operations in accordance with GASB 62. I'm going to take a little bit more of a deeper dive into calculating, lease terms for lessors. So for a contract to be short term, as of the day of signing, the contract has to have a maximum possible term of 12 months or less, including any options to extend, no matter what the probability of it to be exercised. Now, for a lease that is cancelable by either party as a lessee or lessor, including rolling month-to-month or rolling year-to-year leases, the maximum possible term is that non-cancelable period, including any notice periods. But be careful, again, of these fiscal funding clauses. Even as a lessor, you may be dealing with another government that may be beyond your reporting entity. Those are fine for budgetary purposes, but for GAAP, do not say that these are operating leases. Let's not go down the rabbit hole with some of the examples on the screen here. Again, be careful on the short-term piece. Some changes are coming to clarify those in GASB 99. So how do we determine the lease term? And again, print this out, dog-ear it, bookmark it. I have it up over here on my left. Just keep this in mind. You got to identify the non-cancelable period. Now that's the period where neither party can cancel the contract. And then do you as a lessor have an option to extend the lease? If yes, then you add that to your non-cancelable period if it's reasonably certain there's going to be an extension. Now, do you have an option to terminate the lease as a lessor, but it's reasonably certain that you're not going to exercise that option? Now, if yes, add that on as well. Now, again, does your government as a lessor have an option to extend, and it's reasonably certain that you're going to require that extension from the lessee? And if yes, then add those periods. And again, so you can see how this all adds up. And you sum it all up, and that's your lease term. Now, again, there's going to be some wrinkles that are out there. The biggest one uh, being the options. Now, if there's an option to terminate, let's break that down a little bit. An option to terminate is an unconditional right that exists within the lease contract. Now, a provision that gives either a lessee or a lessor a right to terminate the lease in certain circumstances, such as an action or inaction of another party to the lease contract, that's not an option to terminate. So just be careful when you're reading about those termination options. So let's say, for example, there's provisions that allow for termination of a lease due to a violation of the terms and conditions, such as, say, your daycare center defaulting on payments. Those aren't uh, considered options to terminate the lease. And the opposite applies as well, especially to purchase options. Now, let's say the daycare center has the option to purchase the space during the lease term, and the contract is not a contract that transfers ownership. Well, the lease term should exclude that period, if any, after the date at which the option is reasonably certain to exercise. And again, we're going to talk about transfers of ownership in a jiffy. The biggest deal is going to be the closure of a loophole that may have allowed a boatload of short-term leases. Now, GASB 99 clarifies the situation where periods for both the lessee and the lessor have an option to terminate without permission from the other party, or if both parties have to agree to extend. Those are cancelable periods and they're excluded from the maximum possible term. But here's the kicker. A lease that had previously been determined to be short-term and now has been modified to extend, well, guess what? The initial maximum possible term under the lease contract, that should be assessed from the inception of the lease. And if the reassessed maximum possible term is greater than 12 months, well, then the lease should no longer be considered a short-term lease. For a lease that is reclassified from a short-term lease, the lease term now is going to be assessed from the beginning of the period of the date of modification for purposes of measuring the lease receivable. So let's say you make a decision to extend a lease and you're modifying the existing terms and conditions, and you make the decision on June 22nd. Okay, you don't go really back to July 1st because you didn't predict it was going to be extended. Now you start the clock ticking at June 22nd, and then you move forward from there. And if you're at a long-term lease, at that point, guess what? You're at a long-term lease. Again, you have to have a modification of the original terms, which might be hard to come by these days because of inflation. The reassessment would be from the date of the modification. But for this year, it's pretty easy, especially if you haven't fully implemented GASB 87 as of yet. The provision is effective for periods that began last week, meaning beginning after June 15th. But if this is your implementation period, really think long and hard about implementing that early, but you got to be careful. Okay. Now that I vented a little bit about GASB 99, how do we calculate a lease term on a real lease as a lessor? Now, this is a real document. This is a lease of a cell phone tower on a piece of county property for one of our clients. Now, one can say that this might be a little bit immaterial, but let's just keep going here. There's a further wrinkle in this because this is a sublease. Now, the rent is $101.50 per month, and it's due the first day with 3% annual increases. So it's due the first day of the month. There's an additional $50 a month payment to provide maintenance on the access road to the tower. Now, the original lease was signed decades ago, 40 years ago, between the landowner and the county. And the new agreement is between the county and a city that's within its jurisdiction, but it's a separate reporting entity. They're unrelated, so GASB 87 applies. Now, there's some particulars here. Okay, there it changed. There are some particulars here on the cell phone tower sublet. The term of the contract is for 5 years. Now, it began on March 1st of 2017, and it was supposed to terminate this past February 28th, 2022. But the city extended, as they have the right to extend for 3 additional 5-year terms. Of course, that's 15 years. 3 times 5 is 15. Now, I understand that they already extended this year, but remember, we're implementing back this past July 1st of 21. And actually, this county implemented a year early. They early implemented GASB 87. Now, this lease was really slick, as the same terms and conditions carry forward, and the lease automatically renews unless the city gives 30 days notice. Now, per the county, the city was reasonably certain to renew due to the cost of removing the cell phone tower equipment and the easy terms and conditions. Now, the remaining term is 200 months from July 1st of 2020 because they early implemented. Now, had they didn't early implement it, well, 200 minus 12 months is 188 months. So again, as all of us know math, we can figure that out. All right, now let's put those numbers into text. Using our equation, we have 60 non-cancelable months, which occurred which 20 are left, and the county early implemented GASB 87. We're reasonably certain that the city will extend to the terms and conditions. And in fact, we already know since they're already renewed. And so we know by hindsight. Notice I'm saying 200 months and not 16 and 2/3 years. 200 months is very different from the 16 and 2/3 years, as we'll need to use the effective interest method in calculating and amortizing. All right, let's go deeper on the contracts that transfer ownership. Okay, if the underlying asset is sold by your government, that is a lessor. Now we got to take a slightly different approach. And again, these things were usually entitled tax exempt lease purchase agreements, sales type leases, direct financing leases, leverage leases, or something similar. Don't call them George. There is usually a language within the agreement that contains some form of transfer of title. There should not be a termination option, but there may be a fiscal funding clause if the other party is a government. Now, obviously, if it's a private entity, chances are they don't have a fiscal funding clause. Again, we got to have a bona fide transfer. The transaction must be a real sale of real estate in a transfer, resulting in a transfer of ownership of the underlying asset. Now, if that's the case, the entry for your government, it's pretty easy peasy. Now, reclassing the existing lease obligation to a note receivable, pretty easy in terms of debits and credits. You no longer have a lease, you have a note. Remember also, you would also record a debit to the accumulated depreciation you may have, in this case, it's a building, and a credit to the capital asset if there is a real transfer of ownership, a real sale. And the difference is a gain or a loss. Now, with that, now that we've explained that fully to you, I'd like to hand it over to you, Brian. Brian, why don't you take us through how we're going to recognize and measure the lease receivable for lessors? Take it away, Brian.
All right. Everyone can hear me? Give me a thumbs up. All right. Thanks, Eric. Well, thank you very much. Yeah, and as Eric said, really once you figure out the time element, and waiting for the slide. There we go. Once we figured out the time element, whether the contract is in scope, we've got to do some math then to figure out the numbers. Where do we begin? I'm going to make this sound very simplified on this slide, but of course, if you've got any experience trying to interpret or implement GASB 87, it's not simple. So we'll get into more of the details after this slide, but just to try to highlight it for you, really want to get to the meat of the accounting for the lessors. If a government is a lessor, the government will report a receivable that's measured at the present value. We're very familiar with that term, present value, fair value. The present value of the lease payments as of the date of the beginning of the lease term. That's the debit. Figure out what that receivable is, book it as your debit. What's the credit side? The credit's going to be a deferred inflow of resources unless, so here's the big unless. If it's a short-term lease, if the lease results in a transfer of ownership of that underlying asset. In the case of that situation, that would just be a sale where the selling government is financing the purchase. Or if the lease is for income or profit, which I'll talk about in a minute. Also, if the lease is for certain, but not all regulated leases. So a lease that transfers ownership is a financed purchase if the underlying asset truly is sold without any sort of termination options. There may also be a fiscal funding or cancellation clause that's attached to the sale, but if it is not reasonably certain that those clauses would be exercised, so that cancellation clause that's attached to that sale, if it's not reasonably certain that it will be exercised, it would still be a sale from the lessor government. And then the very last item on this slide, of course, any initial direct costs, legal issue or legal costs, etc., those are all expensed. All right, so what about leases that are investments? So let's get through those first. To have a lease as an investment, the lease document must meet the definition of an investment. We've learned that over the last few years as we've implemented GASB 72. You heard Eric say early on in this presentation that we're now into triple digits, 100, 101, 72 sounds so long ago, but it was pretty recent for a lot of us. So in this case, the lease would need to be primarily for the purpose of income or generating income or profit, and can generate cash or be sold to generate cash. Again, a lot of these types of leases would be held by pension or OPEB trust funds. So to be an investment, the lease would need to be measured at fair value. So there's another kind of key term, present value, fair value. We've heard a lot about those in all of these GASB-87 discussions. So that means if a pension plan leases out a portion of its headquarters building for income or profit, the plan usually sets that up in a title holding company or something similar to protect that plan, that pension plan, from risk. So that said, that title holding company would need to be valued at fair value with each reporting period. Usually some form of independent appraisal will work if the assumptions are reasonable. The note disclosure for these types of leases that are determined to be investments, very much aligned with all other investments. Additional disclosure if the lessor has any debt that's issued that is secured by the lease payments, but otherwise very similar. So the pictures depicted on this slide are very much done on purpose. Regulated leases. So the most common regulated leases, which those are subject to laws, regulations, court judgments, and similar, but really the most common would be airports, where there's regulated leases that specifically deal with gate slots or other aviation activities, and then ports. Ports are also another common area of regulation. So I talked a couple slides ago about certain regulated leases. So if your government has regulated leasing activity, revenue is recognized according to the law, regulation, or judgment. Fairly simplified way to account for that lease activity. The rates must be reasonable, and the government has no right to deny a lease as long as the lease complies with that law or regulation. There's required disclosure for regulated leases. It's very simple. Very much like any current disclosure. Airport leasing. We're going to talk more in depth about airport leasing. Likely that a lot of attendees here on today's webinar have applicable airport leasing, so definitely want to spend some time talking through that. It's a little confusing. Could be confusing in similar fashion if you've been in an airport recently, where maybe we haven't had a lot of experience being consumers of the services provided in the airport. So now we're getting more used to that, more back into the flow of things, traveling a lot more. And if you've had to purchase an airline ticket recently, you can see the demand is there, as well as some other costs driving up the cost back to us. But really, there's two categories of leases at airports: space that is regulated and subject to FAA regulations. So we're going to call that airside. So airside, regulated, subject to FAA regulations. We've really addressed a lot of that already through those regulated lease discussions over the last few slides. The remaining space is not subject to regulation. That's really going to be the focus over the next few slides. That's commonly called land side, not subject to regulation, land side. So regulated side, pretty simple. You comply with those regulated provisions, but what about that land side? So most airports that we deal with do not sign separate leases for each retail outlet. Usually there's one master lease signed, and that's what's signed with a so-called aggregator, not to be confused with alligator, which is all I ever think of when I'm saying that word. And now, unfortunately, I've got that stuck in your head too. So airports or this aggregator really is very much like a shopping mall lease. If there's anyone here who has dealt with shopping mall leases, very similar to these land side aggregator arrangements at airports. You know, an airport, if you think about it, once you get past the gates and once you get, you know, past that air side, it really is very similar to a shopping mall. So, you know, really, if you've traveled recently or if you're traveling soon, you know, take a look at that credit card receipt. The next time you're ordering some food at the Shake Shack, you'll notice that it doesn't have that Shake Shack terminology on there. It's got something like HMS or Westfield or Hudson's, and those are all the aggregators that sign a master lease contract with the airport authority. So that aggregator signs that contract, and then they are doing a lot of different subleasing with all the retail shops and restaurants. From an accounting standpoint and GASB 87, we don't care about those subleases. We just care about those individual contracts with the aggregators. So that does make GASB 87 a little easier, at least within one aspect for airports. I said a little easier, but you don't have to deal with those subleases. Okay, now that we know that, how do we measure the receivable? You know, I said right off the bat that we know the receivable is the debit side, but really we want to get into what does that mean? How is that calculated? And that's what we'll talk about now. So at the date of the lease signing, the date of that signing, the lease receivable is the present value of those lease payments expected during or over that lease term. The receivable then is also adjusted for any amounts of doubtful accounts that are known or predicted. The lease receivable is going to include fixed payments. It's going to include any variable payments that depend on an index or a rate, something like the consumer price index or a market interest rate. That's going to be initially measured using the index or rate at the start of that lease term. There's also potentially variable payments that are fixed in substance, such as ceilings or floors. Residual value guarantee or RVGs, those payments that are fixed in substance. Also any lease incentives that are payable to the lessee. If there are variable receipts based on usage, those are not included in the receivable, as they cannot be measured until incurred. Those are just inflows. So if you've got variable receipts based on usage, that's not included in this calculation of that receivable. Those are all included in the inflows. In some cases, RVGs may be variable or have contingencies attached. If that guarantee is required, that RVG is required, there is a receivable and an inflow for the guarantee, but only if the amount can be reasonably estimated. So usually there's some form of purchase option or else the lease is likely a financed sale. Here's another common term within GASB 87 and probably from the lessee side, the more challenging aspects of GASB 87. What is the discount rate? Just as the case for lessees, there is interest involved on the lessor side. But the lessor is likely going to know that interest rate, at least far better than the lessee, really because the lessor knows what the value is. What's the value of that underlying asset? I mean, you're much more in control of that because you are leasing it out to a third party and you know what the required rate of return is. So there is no requirement to impute the discount rate by a lessor, but you may do that as an option. The imputation would be based on the change in the fair value of that underlying asset. The lessors could also use a prevailing rate for similar terms as adjusted for the credit rating of a lessee. So a lot of this discount rate terminology, methodology, very similar as the lessee side when we're talking about lessor. So in the implementations that we have already worked on at Eide Bailly, where the government is a lessor, usually that lessee has been another government. So the credit rating of that other government, that lessee government, is relatively easy to determine. When you're dealing with other governments, it is a lot easier. The challenging part can come in though when the lease may be for a different term than that lessee government's credit rating adjusted borrowing rate. So those credit ratings, usually are based on a 20 to 30 year debt issuance, where the lease term might just be a 5-year lease. So when you're trying to find those comparable or similar terms, you really got to be careful to make sure that you are aligned and that they are similar. So there is some professional judgment that comes into play, may be necessary when determining that discount rate. Could your government use the risk-free rate of U.S. Treasuries, for example? Yes. That policy needs to be documented. I should say it should be documented. We would recommend that policy is documented. Effectively using that documented policy, and then the period chosen aligns with your terms. So you probably heard this last time I spoke, if you were on the last webinar on GASB-87 from the lessee side, and really make sure you've got a policy, make sure you've got that policy in writing. That will really help all of this, and then follow that policy consistently. That will make implementation a lot easier, and I would say probably more importantly, going forward as you continue to come across the requirements of GASB-87. If you have that policy in place, it's written, you've shown to follow that policy historically, that is going to make it a lot easier in the long run. Not easy, but a lot easier. So once you figured out that interest rate, use the effective interest method to amortize the receivable, just like a mortgage, and we'll see that illustration in a few slides. It looks just like a mortgage. Payments are first allocated to interest and then to the receivable. So again, lessors, you are not required to impute a rate, which would require a complex calculation, but interest rates should be determined by any number of factors, including what's the credit standing of the lessee. After all, the worse credit rating, the more risk, and therefore likely that interest rate would rise, wouldn't it? Are there any restrictions in the contract related to the underlying property? Did the lessee post collateral? If yes, that rate may be able to be lowered as the collateral is going to support the lease and ultimately lower the risk. Finally, what are the terms and conditions within the contract? When will the government receive its payments? All of these could adjust the discount rate. Similar receivables could also be used, but remember the terms and dates. So that's the hard part about that similarity. Was talked about on the last slide about the government's borrowing rate, but a lot of time that borrowing rate is based on 15 to 20 years, where maybe that lease term is only 5 years. So you really want to make sure if you've got similar receivables, that there's also that similar term and also the similar dates. A 5-year lease that was signed 2 years ago with a different counterparty may have a different discount rate than a lease signed 5 days ago for a 10-year lease term. So even though it's like, hey, within the last couple of years, yes, we have signed a lease with a similar counterparty, there's a lot of different variables within that. So make sure you're really thinking through that when you're trying to find something similar to establish that. If you're still having issues, you can always estimate. There's just a lot more professional judgment involved with that, but it is a possibility. If it feels like I'm speeding along, I am. I want to make sure James really wants to provide you, everyone here, the full deck of slides that he has to go through. Him going third. Usually, you kind of squeeze off the last few slides. He said, Brian, Eric, I want to make sure I get through my slides. So I'm trying to get through quick so we give him plenty of time. I'm sure James is just looking at me right now, through that screen, just shaking his head, smiling that I even brought that up. What is what is the credit standing of the lessee? No, I'm sorry, I jumped ahead a slide. We're still not done. What is the credit standing of the lessee? No, my gosh. After I made fun of James there, I lost where I was going. Okay, a little reset. Now I got to do some catching up. Now I haven't even been addressing the slides. In some cases, especially now, you may have to remeasure the lease. Very, very important. Modifications, terminations, those are occurring often as the lessee is having financial difficulty. There potentially some financial difficulty within the last couple of years. And we're really at a point in time right now with the economy. Maybe there's some potential financial difficulty upcoming. The Great Resignation potentially is impacting this and would cause the need to remeasure. So as an example, a coffee shop that is in City Hall and is within leased space within City Hall might be having difficulty actually providing service and creating revenue because many of the workers who typically come to City Hall are working remote. Maybe your or that City Hall or that city government has shifted to a more of a hybrid environment in the long run. That's having an impact on that coffee shop. What if your government leases one floor of an office building to a private party and you've done that for several years, but in the middle of the lease, like has happened in the last couple of years, workers went remote, significant downturn in the local real estate market. So now, that lessee wants to renegotiate the terms because they're not using that space the way they had previously been using it and the way they intend to use it going forward. So they want some reduced rental payments. That all could be, a significant modification that requires remeasurement. So unless, you literally rip up that original lease and kind of say that lease term is ended and we're going to start a whole separate or a whole new lease. Otherwise, you've got to, if that's not the case, then you've got to account for a lease modification and you've got to remeasure that lease receivable. I would say typically those leases are just being modified. They're not being, hey, we're ending this one and creating a new one. They're just modification of the original terms. So then you've got to remeasure that lease receivable. That receivable amount, the deferred inflow of resources, all of that has to be adjusted. However, the extent that change in lease receivable relates to payments just for the current period, that change should be recognized simply as a decrease in revenue. Anything related to the current period can just be recognized in that current period as a reduction or decrease in revenue. Changes in lease term or a contingency that's triggered, potentially a change in interest rate, all of those are examples of what would trigger a remeasurement of the lease receivable. So just really, really be aware of any changes, either kind of within the lease terms, and there's different triggering events that change things, or else modifications because of circumstances, like some examples I've just given you. All of those would trigger a remeasurement of the receivable. Usually when there is a contingency in a lease and it's resolved, the variability in the lease becomes diminished. In many cases, that lease receivable becomes based on fixed payments on a go-forward basis. So again, just trying to give you some different variabilities or different changes that could happen. Now, if the change is solely from a change in an index or a rate, the lease receivable is not required to be remeasured just because the index or rate changes. The only time it would need to be updated is for the change in the lease term or that rate significantly changes the lease receivable. You've heard me say it a couple times, now a third time, I think. Professional judgment. What does significantly mean? That's really up to you. So if that change in term leads to a significant change to the lease receivable, then potentially you would need to remeasure. But I would say normally that would not be the case. Okay, so that was the debit side. I told you that debit side would be easy. Now on the credit side, the deferred inflows of resources, it's easy. I'm just kidding. It's easier. Maybe I should say it's easier. It seems like nothing is easy. As soon as you think it's easy, something happens. There's something's thrown at you that says, yeah, Don't be so comfortable. Nothing's easy with this standard and implementation. You just take the lease receivable at lease signing. You add lease payments received from the lessee that are meant for future periods. So things like security deposits, which a security deposit in all reality is really just at the end of that lease term. If it's a month to month, I shouldn't say a month to month, but you're paying every month. That security deposit really is just the last month's rent at the end of the lease term. So that would be an example of payments received that are meant for future periods, security deposit. You subtract any lease incentives paid, not due, but lease incentives paid to the lessee that would have been on or behalf of the lessee paid by third parties. So sometimes that'll happen. It doesn't come directly from the lessee, but there's a third party that pays it. But if it's all related to this lease agreement, make sure you're including that. And that has to be done at or before the lease term. Payments received prior to a lease term are liabilities, not deferred inflows of resources. These could be receipts by a lessor during a construction period, build out before the lessee gains access to the building. Once the lessee has access, the liability becomes a deferred inflow of resource. So it really has to do with when is there access for the lessee, and that's when that switch happens. The liability becomes a deferred inflow of resources. And then the amortization of the deferred inflow of resources is to revenue. So, if you kind of step back and say, whenever you're recording a receivable, what's typically in the long run the credit? It's revenue. It's the same thing here. Whenever that amortization takes place of the deferred inflow, it then is taken into revenue. That amortization, though, needs to use that effective interest method. Do not use straight line. I told you things aren't easy. Straight line would be easy. We don't get to do that. Leases are financing, so we need to make sure we're using that effective interest method. Also be aware the lease term may not align to the useful life of that underlying asset. For an example, the lease of the floor in City Hall, where I used that coffee shop example, the useful life of City Hall, what is it, probably 40 years or longer. The lease of that floor space and that coffee shop, highly unlikely that it's 40 years or longer. It's probably much shorter, 5 years, maybe a little bit longer than that. But just really, really be aware of that when you're measuring that deferred inflow of resources and determining what that amortization period should be. Okay, that leaves us with that underlying asset. Really, unless it's sold, unless that underlying asset is sold, it's still your government's asset. It's the lessor's asset. So don't take it off the books. It's still there. Continue the standard capital asset accounting, including that provision for depreciation, assessing for impairment of that asset, but treat that asset as you always have. It is a capital asset. Continue to treat it as such. Really, the only time you're going to discontinue depreciation is when that leased asset is to be returned in as good or better condition at the end of the lease than at the start. So of course, when you're depreciating, you're assuming that their useful life is being used up, the asset is being diminished, and essentially it's not going to be in the same condition as it was 5 years ago. But if there's some term within that lease, or I'm sorry, if there's something within that lease agreement that causes it or requires it to be returned to you in as good condition or better, that is going to impact the capital asset accounting. Land, still not going to be depreciated. Don't depreciate that land. Maybe that's an easy part of this. So the very bottom one. Do not depreciate if it's going to be returned in the same or enhanced condition. Breaking news, back to GASB 99. There's clarifying language in this new standard that fixes text on the variable payments piece. So if such payments are fixed in substance, if there's variable payments, but really in substance, there's fixed, meaning there's that floor or ceiling or minimum or maximum, then those payments are part of the receivable. So remeasurement would not be required just for a change in index or rate. I said that a few slides ago. This is really good news, especially in the environment we're in right now. with the inflation where it is, the remeasurement is not required just for a change in the index or the rate. Something else also has to be going on, meaning something like a change in the lease term. So that change in the rate can happen if there's something else going on. That's when there's the potential for remeasurement. So if there's a change in term and a change in rate, remeasurement is required. So again, implementation is for periods beginning after last week, the 15th. Meaning next week for all of you June 30th out there. You may want to consider early implementing. I would say I'm guessing that a lot of the local governments that we work with likely will early implement this GASB 99. Okay, let's run the numbers and then let's kind of see those numbers in practice. I had mentioned, similar to a mortgage, you're actually going to see get a visual on what that looks like. So let's run the numbers. So we've got, let's use a real lease. This is lease of land along a major river, not subject to any federal maritime regulation. It's non-cancelable. The term began on July 1st, 2020, and it lasts for 28 years. So that means 27 years left after implementation by the lessor government. There was an old lease on the property, but that lease has been terminated. The company is a major corporation and is good credit risk. The terms only allow bulk commodities, we'll call it grain and similar, to be loaded and offloaded onto barges. No other purpose can be used without consent of the city as the lessor. So we have some covenant restrictions. Multiple flows on the lease. There's a dockage fee, a monthly fee for dockage. It's adjusted annually by CPI, but capped at 3%. The rent cannot go down. It's about $17,500 per month with the same provisions. And then wharfage is a receipt based on tonnage. The charge is 10 cents per ton for grain and liquid fertilizer. All other allowable goods are 25 cents per ton. So a lot of information there. You can always go back. The slides are yours to take with you once we're done. A lot of information there, but that's really what we're going to use for this lease example. But we're not done. There's more going on. There's more stuff going on in this lease. The company leasing the property from the city has a requirement to put in new landscaping and a flagpole. The company also has exclusive right to use a railroad spur owned by the city so that grain and other allowable commodities can move from the wharf to the main rail line. But that spur that they have exclusive rights to use needs about $1.5 million in improvements to the tune of some new ties and rails. The company also must pay real estate taxes to the city. And finally, the company is responsible for any pollution remediation if they spill into the river. Like I said before, thankfully, you get to take these slides with you. You can revisit all of these different terms and requirements at a later time. So trying to get this into our comfort zone as CPAs. If you're not a CPA and you're on this call, maybe you're an accountant without that CPA designation, but let's be honest, we're all the same. We love spreadsheets. Let's get this into a spreadsheet, okay? So we have a leased asset and a wharf. We've got land and rail spur to a well-known company that is publicly traded. It's a good credit risk. In service July 1, 2020. So we've already gone a year until we implement this new standard GASB 87. 324 months left in a non-cancelable term. Payments are at the beginning of the month. Land and other assets must return to the city at the end of the term. Due to the credit risk and other covenants, the city set a discount rate at 3.5%. Remember, the payments are adjusted by CPI at a maximum of 3% annually, but they do not decline. Since we have rising sets of multiple payments, the math is a little tricky, but I would say this is intentional. We want to kind of lay out a complicated situation so that when you go back, hopefully you don't encounter something so complicated and you feel like, oh, that was easy, easier. So our time factor, 324 months. discount rate, 3.5% annually. But remember, we have to compound interest, those payments monthly. So we're dividing that by 12. And then we've got multiple payments going on, including the dockage and the base rent. Payments need to be inflated by 3% due to the CPI adjustments. All other payments for the wharfage, and these are variable, but we'll talk about those in a moment. Our future value will be 0 as there is no transfer. And finally, the payments are at the beginning of the month. And remember, payments that are at the beginning of the month are different than payments at the end of the month due to the passage of time. So very important on the timing of those monthly payments. Excel can be used on this. Okay, spreadsheets, we love spreadsheets. Excel can be used, but it's not exact due to those rising payments. There's a lot of software out there that can be utilized. We can talk more offline if you're looking for suggestions on where to investigate the potential use of software. We likely are using software here at Eide Bailly to calculate the receivable. If the clients that we're working with are not going to calculate it on their own through either an Excel spreadsheet or software that they engage with. We do have access to software through our relationship with an entity, so we likely will be utilizing that just to feel a little bit safer. All right, here's the result. So based on our calculations, we think the receivable is nearly 5.8 million. Remember, we're at payment 13 at the point of implementation because the first 12 months or the first year have already passed. So at the date of implementation, month 1 of the fiscal year, we're at payment 13. We're going to use the effective interest method to amortize all the periods. Can't use that straight line method. So just to show you the amortization for annual numbers in the first 5 years, here you go. Like I've mentioned a couple times, really does look like a mortgage. Pretty basic, at least output. That's probably the best way I can analyze GASB-87, the inputs, making sure those are accurate and correct. That's the big challenge. Once you get to the outputs, fairly simple looking. Once you get to the entries, fairly simple looking. It's those inputs that are challenging. You can see that years 1 through 5 thereafter, and then the total at the bottom there, at least on the principal column, roughly 5.8 million. Bring into our into the header of this slide our Eide Bailly technical terms. What about the other stuff? The wharfage, it's based on tonnage loaded and offloaded, so purely variable. That's an inflow. The improvements are the property of the company during the lease term and then surrendered to the city at the end of the lease term. Remember, I talked about those improvements before. But let's assume the value would be 0 in 2048, as it is 2021 when we implement. So there's some language in the yellow box there on this slide. The railroad spur may be funded from federal or state grants passed through the city, so the lessee would then pay the difference. The lessee company would maintain the tracks but allow the city to use them. Really, let's call those separate transactions as they haven't occurred yet. So there are likely grant transactions occurring, so just be aware of that. And then finally, the taxes receivable would be reported by the city like all other property tax receivable and deferred inflows of resources. Those should be reported separately from the lease. A lot going on here. I want to give James plenty of time for his section. So I know I went through it quick. The good thing is take the slides with you as you read through them again, refresh your memory, maybe spur some more questions. Make sure to reach out to Eric, James, or myself, and we'd be happy to help. Okay, what are the journal entries? So I told you, kind of the outputs, which we just went through, and the journal entries, definitely the easier part of this implementation. Once you get to those parts of, or those stages of implementation, you're probably feeling pretty good. And as you look at this, they're very simple, very basic, very easy. So first of all, remember, remove your old receivable by crediting it and debiting any related deferred inflow of resources. If you had an old receivable, we're going to record a new receivable and a new deferred inflow for that 5.8 million. If there was a security deposit or a collateral, then that's a separate entry, but we didn't have that in this example. Now you might be saying, would that be in a governmental fund? And the answer is yes. If that's where the city's leasing operations, I should say the entities, but in this case, we're following an example that is a city. If that's where the leasing operations are reported and it's a governmental fund, yes, lease receivable and deferred would be the same in a governmental fund as well as government-wide under current GAAP. So therefore, the conversion entry to entity-wide is very simple. Just reclass that current portion. And just a reminder, adjust for any uncollectible amounts. And remember that property tax receivable reporting is just like any other property tax receivables, and it's done separate from this lease entry. All right, what about year end? Exactly like today. Those year end entries are exactly like today. We're going to collect cash. We're going to lower the deferred inflow of resources. We're going to lower the receivable, and we're going to recognize revenue. Really, the only thing that remains is that reclass of the current portion in the government-wide statements. Simple, right?
All right, Brian, that is so kind of you for speeding through those other slides. So for those of you who weren't unable to attend the last presentation, Brian was so thorough and long-winded, I mean, comprehensive, that I had to shorten my section. So fortunately, I talked a lot about the upcoming pronouncements for next fiscal year. So there's still time to talk about those in the future, but for now, I guess we're just going to go into the adjustments to recording the leases and some considerations that you have to make. So components, they're especially common for space leases. So you heard about a variety of components in the WRF lease, including property taxes and landscaping. So they're separable. These are separable elements in each lease. So other elements can include common area maintenance or CAM charges, like just general maintenance, utilities, security, parking, all those kind of variable costs are those costs that are intrinsic to that lease agreement. So in any lease, we'll need to do our best to separate out those components and estimate their value. So some of those CAM charges can be figured out by reviewing similar contracts that don't involve leases. You may have an allocation schedule. If you're a lessor and you're providing that maintenance, you may have an allocation schedule that you allocate to your different lessees, your different lessees that you're contracting with. You can consider that. So there could be a significant amount of judgment to this. So don't take this one lightly, because that's definitely one of the considerations that you need to have. In a lot of cases, there are multiple components involved. So just think of the space you're going to be leasing. It's going to involve any one of 5 elements on the screen, in addition to principal and interest. So these are additional components to that lease. So to determine these components, you need to separate out that base payment from these components. So that's going to be your first step. Principal and interest, done. And this other grouping is going to be you're associated with your different components. Components could have different terms. Let's say in an office space lease, parking was outsourced to a separate company that supplied free parking for the first 6 months of a year lease. That's not too shabby. Utilities can be billed separately. And that would include, maybe power, internet, or some other utilities that's going to be separate, because there's meters for each space lease. Those are all components. So we've identified 4 general steps to successfully figure out these components. First and foremost is actually recognizing them and identifying them. Like I said, they could be intrinsic to the lease agreement, so they may be a little bit more difficult to find. So this is going to take you reading those agreements. You could potentially use artificial intelligence to work on this using, different platforms such as, Lease Query or Debtbook, but it's that may not be the most effective way to do it, or maybe not be the most comprehensive way to do it. So you're going to want to at least spot check some of those lease agreements to see if there are any CAM charges or any separable components. So the next step is you're going to look for similar contracts if the contract is not identified in the lease. The example of the 1-year maintenance contract on a truck is just that. However, if we don't know how much the dealer charged for maintenance, or if it was completely variable, then you can use professional judgment. That's similar to like setting those indirect costs when I was talking about that allocation schedule. So if the cost turns out to be over or under, if the actuals turn out to be over and under than your estimate, then you would just adjust going forward. If it's still not practicable, if you really can't separate those different components, then just consider it part of the lease. We've got this materiality concept that we have to consider, and there's a practical expedient that we want to evaluate that you just consider that part of the lease. All right, so once the components are identified, you're going to separate those payables from those charges that need to be recorded, unless it's, like I said, unless it's not practicable to do so. So the goal is to maximize the most observational information known. The observable information known. Again, the most common of these charges are going to be your common area charges, or CAMs, like maintenance and security and utilities. If you do allocate property taxes, you want to separate that out as well. So let's take a look at some of the combinations. Or let's take a look at combinations, excuse me. So combinations are different. They could actually really help simplify the recording process for your leases. In the case of the lease of the wharf from the city, it's really a combination that has a single purpose at the same time. We have a wharf, we have a railroad, we have buildings, land, they're all one contract. If you've got these large contracts, try to group as many of these as possible to simplify your accounting for it. It's going to make your implementation that much easier. Remember, since this is lessor accounting, you don't have to classify the lease by the asset type. We no longer have, you don't have to group it by land or by building or anything like that. It's just your lease receivable that you have to consider. When you look for combinations, they're going to be with the same counterparty, with same or very similar terms and conditions, and multiple underlying assets that could be, excuse me, interchangeable. There could also be, when you look at these contracts, don't forget to consider what we just talked about, or what I just talked about anyways, those components. So if there's landscaping charges or property taxes on the wharf and land that is intrinsic to, or common area maintenance that's intrinsic to the lease, you want to consider that. You definitely want to consider that as part of your accounting for it. The next adjustment to leases are lease incentives. You heard Brian talk a little bit about, how to account for the lease incentives, but let's identify what those lease incentives are. So lease incentives are very similar to what we discussed a few weeks ago for lessee accounting. You see that breaking news on the top. I'm going to get that into the next slide. But overall, for lease incentives, they are payments made to or on behalf of the lessee, for which the lessee has a right of offset with its obligation to your government as a lessor. So, and then other concessions granted to the lessee by your government as a lessor. These terminologies are super confusing. I totally get that. So it's best to draw a picture. That's typically what I've done with a lot of my clients, is drawing a picture of what these treatments look like, similar to your T-charts. A lease incentive is equivalent to, it's like a rebate or a discount. It includes an assumption of the lessee's pre-existing lease obligations to a third party, other reimbursements of costs. There could be rent holidays, or there could be reductions of interest or principal charges by your government. So essentially, they're reducing the amount the lessee is required to pay for the lease. Lease incentive payments are provided after the commencement of the lease term, should be accounted for by lessors as a reduction of the lease payments for the periods that they're provided. Those payments are measured by the lessees consistently with the lessor's lease receivable. So it's basically dollar for dollar on both sides of the transaction. So you would want to make sure that, well, I guess it's not your responsibility for the lessee accounting, right? But you want to communicate the amount that you're recorded. That breaking news, and I honestly feel like we should have had some background music for breaking news, but GASB 99 amended the text of GASB 87 by adding the possibilities of incentives to include items such as an assumption or agreement to pay pre-existing obligations to third parties. This could be something like, if you move here to our building, we're going to pay off your existing lease and we're going to pay for your moving costs. That's a type of an incentive that that was included under GASB 99. Some things to consider. So just like with lessees, there's accounting events if modifications and terminations occur. As a reminder, modifications occur when an amendment occurs adjusting that all important time factor, or in some cases, the interest factor. So if one of those two occurs, there's a modification. Modification can be a termination if the right to the use of the asset decreases. So if basically the scope, if you're saying, here, lease this building, we're leasing this building to you, oh, you know, and then halfway down the lease term, you're saying, well, we're only going to lease half the building to you, or the lessee comes to you, says, we only want half the building. That would be considered a modification. If assets are added, say new vehicles, the lease may need to be recalculated. So something to consider. If a termination occurs, especially if it's early, it could result in a gain or a loss. So you need to have these provisions in mind when you're implementing this standard. Let's see here. Modifications, because nothing is clear, right? There's always an if-then statement. There's always clauses. So if there's a modification, unless a modification is reported as a separate lease, your government as a lessor should account for a lease modification by remeasuring the lease receivable. The deferred inflow of resources should be adjusted by the difference between the receivable immediately before the modification and the remeasured receivable. However, to the extent that the change relates to payments for the current period, the change should be recognized as an inflow of resources or an outflow of resources, depending how it goes. If there's a termination, your government as a lessor should account for the partial or full lease termination by reducing the carrying values of the lease receivable and related deferred inflow of resources. And you're going to recognize a gain or a loss for the difference. It's very rare that you'll see them equate one for one, excuse me. However, if a lease is terminated as a result of the lessee deciding to purchase the underlying asset from the government, the carrying value of the asset should be derecognized and included in the calculation of the resulting gain or loss. All right, clear? All right, let's move on. Now, if the modification occurred due to a debt refunding, when the savings is given to the lessee, which take a look at your contracts, that could be required as part of your contracts, then you're going to adjust the lease receivable to the present value of the future lease payments based on the interest rate applicable to the revised lease contract. You're also going to adjust the deferred inflows of resources by the same amount. The adjustment to the deferred inflow of resources is going to be recognized as an inflow or outflow of resource, like a gain or a loss over the remaining life of the old debt or the life of the new debt, whichever is shorter. So they're adding that provision in there to account for, whichever one is shorter. Now, if a change to the provisions of a lease result from an advance refunding that results in defeasance of debt, your government then systematically recognizes as revenue any reimbursements to be received from the lessee for costs related to the refunded debt. And you're going to recognize that revenue over the remaining life of the old debt or the life of the new debt, again, whichever is shorter. Just so you know, we're not making this stuff up. This is longstanding GAAP that's been in place since the 1990s. So take a look at GASB 7, GASB 23. It's been modified slightly under GASB 65 for the terminology difference, but they're basically reapplying that GASB information back from GASB 7 and GASB 23. So it's been a hot minute since we've had to take a look at those. So now we're going to take a look at note disclosures for lessors. So this is one of the times that this GASB 87 is making it a little bit easier for you as a lessor, in that there's going to be no more operating lease disclosures. Those are completely gone. We've eliminated that term operating lease. The only things that are required for most lessors includes kind of a general description of the leasing arrangement, which includes the basis, terms, and conditions on which variable payments not included in the measurement of the lease receivable are determined. But only include the variable information if they are not in the lease receivable. If they're pure inflows, you want to make sure that you disclose that. The total amount of inflows of resources recognized in the reporting period from leases, if the amount cannot be determined based on the amounts displayed on the face, but only include that amount if it is not on the face of the financial statements. Remember, it's not just the statement of activities, but it's going to be on the fund statements as well in this regard. The amount of inflows of resources recognized in the reporting period for variable and other payments not previously included in the measurement of the lease receivable, including inflows of resources related to residual value guarantees and termination penalties. Again, only if these are applicable. We don't want to have any negative disclosures in the financial statement. So if they're applicable, include them. If they're not applicable, mum is the word. Let's keep it on the DL. Finally, the existence, terms, and conditions of options by the lessee to terminate the lease or abate payments if the lessor government has issued debt for which the principal and interest payments are secured by lease payments. But if your government has not issued debt to secure the payments, no disclosure. So in other words, this is pretty straightforward, right? Clear as mud. Now, if you've got these types of activities, you may have additional disclosure, but only if you have them. So leases as investments, you already presented information on them as part of your investment disclosure. The only other information that you need to include with leases for investments are options to terminate. Regulated operations disclosure does not change from pre-GASB 87. So you're going to have very similar disclosures. Subleases is a general disclosure, but keep in mind that both sides of the transaction are going to be disclosed. So you as the lessor and you as the lessee. For sale leasebacks for lessors, disclosure is only, basically what we just talked about on the previous slide. So there's no significant changes to there. Now, if your government's principal operation is leasing, and only for those governments whose principal operation is leasing, 5 years of anticipated receipts, principal and interest, and then an aggregate 5 years, each 5 year thereafter. Again, only if your principal operation is leasing. If you're a county government, a city government, or special district that provides services that is not leasing, you're not going to disclose that information. GASB 94 for government transfers. Just as a side note, this last presentation from a few weeks ago, we talked about both GASB 94 and GASB 96. GASB 96 relates to SBITAs or subscription-based information technology arrangements. Those are that particular statement has no provisions for lessor accounting. So it's purely focused on the government has got this right to use of this intangible software or asset, based on this technology arrangement, and there's no provision for the government to lease out information or information technology arrangements as the lessor. So we're not going to be talking about that other than what I just said now. All right, GASB 94. I'm going to have a hard time with this. Public, private, and public-public partnerships and availability payment arrangements. Talk about alliteration. So we're just going to call them P3s. There's also an aspect of availability payment arrangements. And then keep in mind so this is a future pronouncement. This pronouncement actually, the start date for that started last week. So if your period began on June 15th of 2022 or afterwards, that's when you're going to start implementing. That's the effective date of this statement. So the P3 standard modernizes the service concession arrangement gap. This was issued in 2010, which is well before the current leasing provisions in GASB 62 and of course GASB 87. Much of that SCA guidance or service concession arrangement guidance does not change dramatically, but some of the payable receivable measurements will change. Understanding the lingo is going to be like any other standard. Once the definitions are known and translated to common English, the accounting and then the financial reporting is fairly straightforward to place into practice. So looking at the definition, if you haven't fallen asleep as of yet, or if you haven't got confused or cross-eyed with all the terminology that we've discussed, we're going to go into these definitions. I'm going to start with here we go again, public-private partnership and public-public partnerships, P3s, which is an arrangement in which the government or the transferor contracts with an operator, which could be a governmental or a non-governmental entity, to provide public services by conveying control of the right to operate or use a non-financial asset, like infrastructure or any other kind of capital asset, which is going to be your underlying P3 asset for a period of time in an exchange or exchange-like transaction. APAs, or availability payment arrangements, is an arrangement in which a government compensates an operator for services including designing, constructing, financing, maintaining, or operating a non-financial asset for a period of time in an exchange or exchange-like transaction. Could result in a transfer of asset or just an outflow of resources. Keep in mind both of these, or all three of these, are exchange or exchange-like transactions. So there needs to be some give and take. It's common to be confused by this lingo. So the easiest way from this confusion is to go through a couple of examples. So starting with an APA, availability payment arrangement, just because I want to go in alphabetical order now. In this example, a corporation or developer designs, builds, finances, and operates a mass transit system. The corporation runs the system entirely for years in accordance with the contract. All fares are remitted to the government, so the variable payments, but the government turns around and remits fixed payments back to the corporation based on certain milestones. That's an APA. Certain milestones could be something like miles traveled, passengers picked up, something like that. You can definitely define that. Excuse me, I forgot to advance my slide. So now we've got two types of P3s. One type is with, moving on to the next one is we've got a public entity and a private entity. One could, they could both operate a toll road. They may or may not meet the definition of a service concession arrangement we talked about previously. The counterparties earn revenue from the tolls collected by and the government receives payments from the counterparties. Finally, and this is a common one, we've got a golf course and a pool owned by city government and operated by a private entity. That's a classic service concession arrangement and is most likely a P3 under this GASB. We've got clients with campgrounds and water parks that have similar arrangements, but so those are the kind of the arrangements that you need to start considering when implementing this GASB next year. Well, I guess as of last week, right? These P3s are common. These examples are common as infrastructure needs are growing and governments are realizing that having a golf course is not necessarily what it used to be with rising costs. There are more than just highways, but think about this list as some of the examples that we've talked about, and then think about the operating environment that we're in today. So transactions could differ based on the circumstances. If the P3 does not meet the definition of a service concession arrangement, so you still have to go through that decision tree to decide on whether or not it's a service concession arrangement, then you fall back and you are in what Brian and Eric were talking about earlier. You're in a GASB 68 situation. You have a lease agreement or a lease arrangement. Now, let's say that your government transfers an existing asset to an operator. No new asset is built, but it's also a service concession arrangement. So, you've got this key thing that it's a service concession arrangement. Then you apply GASB 94 and you've got a receivable and a deferred inflow of resources, just like you had earlier like you listened to earlier for lessors that Brian was talking about. All right, so I know this is fun, right? So let's say you've got a transfer but new assets or improvements are also occurring. And we meet the definition of a service concession arrangement. Well, guess what? We're going to recognize a receivable and a deferred inflow of resource. Now, if we do not have an SCA, but we have a new asset or improvement being built, there's not only a receivable and inflow of resource recognized, but we also have a receivable for the acquisition value of the new assets. So if it seems like you're almost doubling up on the receivable when you're considering that kind of aspect or that kind of transaction. I'm going to put this in a visual now. So like the SCA, there's a decision tree. So first, let's look to see if we've got a P3. If the government has a P3 that makes the definition of a lease, but not an SCA, as I just described, then we're back at GASB 87. So what about the other definitions? If the government that is involved in a P3 transfers an existing asset to an operator, then GASB 94 applies. A receivable is declared and a deferred inflow, just like the GASB 87 for lessors. It's almost the same calculations, but both of those are recognized. If the P3 involves either a new or an improved asset, but it meets the definition of a service concession arrangement that is purchased or constructed by the operator, then the asset that is purchased or constructed is recognized by the transferring government, not necessarily the operator. There's a receivable for the installment payments and a deferred inflow of resources, just like the receivable, lessor receivable. Now, what if a new asset is acquired or purchased, but it does not meet the definition of a service concession arrangement? Well, the asset is acquired or purchased and is only recognized at acquisition value at the future date of transfer, which could be 2 years from now, 15 years from now, 40 years from now, whatever the end of the P3 arrangement is. Again, we've got a receivable and a deferred inflow of resources, just like the lessor. Once we break it, I think once we break it down to a tree like that, it's a lot easier to deal with. So what we're recommending is take this tree, you keep it on the side of, keep it on your desk in case you come up with an agreement for somebody to operate some kind of asset on your behalf. So that way you can determine whether or not it's a P3 or an APA. So we're going to go through an example, and that picture is one of our clients in San Francisco. But let's say the Department of Transportation is a transferor, meaning that they own the bridge. Let's say we engage the county to design, build, and operate a new bridge. To compensate the county, they get to retain the tolls, and the county authorizes authority sets the tolls. So we've got the authority, the department, as well. We've got the State Department of Transportation, and we have the City County of San Francisco. So to compensate the county gets to retain the tolls, and the county authority sets the tolls. So it's not a service concession arrangement. At the end of the agreement, the bridge is returned to the state. Here we have multiple year construction with a cost of 1.2 billion and a life of 40 years. Remember that time span. At the end of the contract, the carrying value is 300 million, and guess what? Only 10 of 40 years is left. Now for the debits and credits. For the county as an operator, they're going to debit capital assets. They're going to debit a deferred outflow of resources for the carrying value of the transfer of the remaining 10 years of the bridge life, and then credit a due to and credit CIP. At least once the bridge is operational. So as normal accounting, as the bridge is constructed, CIP is debited and cash is credited. For the state as a transferor, the state debits a receivable for the 10 years left on the bridge and a deferred inflow of resources, as the transfer will not occur until 30 years from now. As the bridge is operated, the county recognizes the tolls, depreciation, amortization. The state's going to recognize revenue annually by amortizing the deferred inflow of resources. And in this case, straight line amortization seems to be fine. The implementation date for June 30th, I touched on this earlier, started last week. It's going to be implemented effective July 1st. So just like GASB 87, you're going to want to use the facts and circumstances as of the date of implementation. So try not to get confused with the work that you're doing on GASB 87 at the same time. Remember, we have another pile that Eric talked about earlier for GASB 94. So work on GASB 87 first, because guess what? Your auditor is going to be asking for that this year, not next year. For audit purposes, GASB 94 transactions do not occur daily. These are definitely complex transactions. And you're going to need, if you need help, definitely reach out to us, as well as your audit team, for that assistance. So speaking of audit, we're going to talk about a couple of audit issues that you're going to encounter this year. More likely than not, you're going to encounter. If we think about GASB 87 and various audit assertions, completeness is going to be the big key for this. Governments are going to need to evaluate all your contracts to determine whether they are in scope or out of scope, or if they even have any kind of lease considerations. Creating an inventory of all leases is the first step for most governments in implementing the statement. Furthermore, strong internal controls over contracting is going to be needed to ensure that all leases are identified by accounting and the procurement process evaluated to ensure proper capture. That is, specifically for you decentralized governments, identifying all those contracts that are, by departments, that are developed by departments. Maybe each department has a procurement section. Consolidating that information is going to be key. So just keep in mind, governments routinely sign contracts that may or may not align to a definition of a lease. They don't necessarily use the word rent or lease. Or they may not even use the word asset in there. These contracts are not identified under the old lease accounting guidance, which was primarily GASB Statement 62. Given the limited impact of the failure to identify a lease under GASB 87 guidance, pre-GASB 87 guidance, they may not have identified embedded leases that we talked about. However, identifying leases with GASB 87 is going to be very, very important. That's going to be kind of the key thing. Recognition and measurement is also going to be, oh, excuse me, I skipped ahead. Is important for your policies and procedures. Are they effective and utilized for your recorded contracts? And then there's presentation and disclosure, but that's not going to be as significant. Your auditors are going to be reviewing your financial statements to make sure that all the presentation items are included. There isn't too much that changes other than removing operating leases, since that term no longer exists. So that's going to be the last thing that you're going to consider, but completeness is the very key thing that we've got to consider. Compliance and related parties, they're going to have to be considered. So just kind of items to focus on that, continuing disclosure requirements, debt limits. Are there any federal awards that are going to be impacted? You saw these issues last month, but it's definitely worth repeating because there are so many, these issues are voluminous, right? There's so much to consider. We're going to talk about implementation. This is the part that I tried to focus on a little bit more from our last one, but it's worth repeating. So first of all, gather your team. It could be a team of one. We used to have the army of one. Now it's a team of one, but you could have multiple people across, multiple functions, like the accounting team, kind of key, purchasing, legal, governance. Gather that team. Think of all the touch points in your purchase cycle. Think about IT. They're all important for implementing GASB 87. And then keep this team together for GASB 94, 96, 99. This isn't a set it and forget it kind of thing. You have to keep implementing GASB 87 for the rest of our lives, our professional lives anyways. Public Works is going to be a key one for, your GASB 94 for the P3s, because they may be entering into these agreements. Key management personnel. GASB 87 requires leases to be measured using the facts and circumstances that exist at the beginning of the period of implementation. So July 1st, as of last year. This allows for the use of the carrying value of the existing capital lease asset adjusted to the new carrying value of the lease liability. So you're going to try to make those, you're going to make those equal as of the beginning period. It's retroactive to implement. To sum up, we need to look at all our contracts to the point of implementation, we need to take that inventory of all of them. Again, that completeness assertion that we have to consider. Then you're going to use the facts and circumstances at the point of implementation, which for many of you may have been the Friday before July 4th. However, if any of you have comparative financial statements, you need to go back yet another year to July 1st, 2020, so that you would have those comparative statements. They would look very similar. I have one final piece of advice for you. You're not going to stop implementing. I mentioned that you're going to be implementing this for the rest of your professional life. The statement is here. They're not delaying it. And it's going to continue on until the GASB decides to supersede it or to do something else with leases in the future, but it doesn't look like it's going to go away in the next 20 years or so. So with that, I'm going to open up to any final questions that you may have. And Eric, Brian.
Sure. Excellent job, James. I'm going to try to answer a bunch of questions live. Going back to the first part of the presentation, what's the term where, what is the term where a lessee has the right to unlimited 5-year extensions? Well, the term would initially be the non-cancelable period, but then it's adjusted based on the reasonable certainty as to whether or not the lessee will renew. And if that can't be calculated, you're really at the the non-cancelable period. And so just keep that in mind. A couple of folks are asking about spreadsheets and so on, and I'll answer those directly. There's also a lessee question in there that I couldn't get to. Again, I'll try to answer that directly. Now, one question was asked on a golf course. Is a golf course an SCA even if it is open to anyone, not just citizens of a municipality? And James, I know one pretty well. I know a bunch of these. I think I think the answer is yeah. I mean, there's one here in my town that was pretty famous last weekend because that's where a lot of the cars parked for the US Open was on the town golf course, which is an SCA. Now, I mean, I'm sure you have clients that do have municipal golf courses. And I know they're prevalent in California. I mean, is a golf course an SCA even if it's open to anyone, not just citizens of the municipality? What do you think?
Yeah, I don't think the restriction on the customer base is a significant consideration for the SCA, as long as the players are willing to pay the fee, the green fees to play golf.
Yep.
Then it would meet that definition.
Yeah, and in fact, there's a very famous one where a very famous and expensive PGA event occurs every February. That is a public golf course. It is in a very picture. Let's just say it's Pebble Beach. And I think the greens fees are what, $500 a round or something like that. But that is a public course that is run by a private consortium, and that is an SEA. And so it's I think owned either by the county or the city of Carmel. And there is one down south that used to be one of my clients surrounding a very famous stadium. And those are open to pretty much anybody who's willing to pay for it. There was a question, as a lessor, when we initially set up the debit, receivable, and credit deferred inflow, this will only be on the government-wide ledger for government funds. Is that correct? Yes and no. It really depends on where the contract is recorded. It could be in proprietary funds. I mean, Brian, would you agree on that? And I think it really depends on where the contract's recorded, correct?
Yes, that's correct. If that contract originates and is receipted into the general fund as a governmental fund, that would be recorded there, a receivable and a deferred inflow. The only impact on the government-wide then would be a reclassification of the current portion. But otherwise, it does impact those governmental funds.
Excellent. All right. So there's been one young lady I'm going back and forth on during the presentation. How do you figure out a present value of a receivable on July 1st of 21 if there's no fixed monthly payment and the lease payment is only based on percentage of gross sales during the lease term, for example, a 10-year lease? And these are excellent questions. And there's bound to be a bunch of these questions that are out there. If it is purely variable with no minimum or no maximum, then the payment usually doesn't occur until an underlying sale occurs, as an example in this case. And until that sale occurs, you don't have a receivable. And that's the same as any other rental arrangement. So there's no way you could present value it. Any differing thoughts, gentlemen? They're both.
No,
James?
I mean, there's nothing to really measure if you don't know. I mean, you have to assume the base value is 0, right? Because there could be months that there's 0 inflows that you would just use that as your base value. And so there's nothing to really record with that. So,
Right. And again, if it's only based on sales, it's similar to what you described as an APA. Until the revenue happens, you don't have a receivable.
exactly.
Yep. And then the initial measurement of a receivable, when measuring receivable, when payments increase each year, how do you calculate that, out your payments? Well, again, the easiest way to do it is through software, but that only changes really your payment. It doesn't change your interest rate or things like that. You only need to do a modification of the receivable that you record at implementation if something else changes, such as your term. And that is one of the major changes in GASB 99. So yeah, I mean, your payment may indeed increase, but you only measure it as of the date of implementation. Now, now to wrap things up, I know we're in overtime here, and so I want to really thank you all. During our series for GASB 87 over the last few years, thousands of you joined us, and we've answered hundreds and hundreds of questions. So I really want to thank you all, and certainly reach out to us if you need help in GASB 87 in the future. And with that, hand it back to Amy.
All right, everyone. Well, thank you for staying just a few minutes extra. Thank you, James and Eric and Brian, and we hope everyone has a good rest of their day. We will see you guys soon. Thanks for attending.